into break, we were talking about how Maruti's moved to the high point of the day and how a lot of these auto stocks have recovered from the lows. But talking about auto stocks, auto ancillaries, they are the ones which have moved fairly fast. Today's trading session, we have something like a Rane Brakes as well as, Rane Group stocks, all of them, Rane Madras and Rane Brake, moving higher just as we speak. Rane Brakes is actually higher by close to around 14-15 odd percent when I last checked. And take a look at the last 1 month chart, it's up by around 40 odd percent. That's not all. We had something like an Igarashi Motors as well, higher by about 60% in the last 1 month. We've seen a big move coming by in Sterling Tools as well. Yesterday it was up around 14.5-15 odd percent. And alongside that, we've had something like a pre-call, which is high by around 28% for the last 1 month. So auto ancillaries moving, auto stocks moving. Are they smelling in some recovery or not is the big question. But talking about recovery, consumer giant Hindustan Unilever reveals the real reason behind purchasing GSK consumers brands like Horlicks, Boost, etc. Sudhir Sitapati, when talking to me about his book, The CEO Factory, spoke about HUL as well. They said they are awaiting NCLT order on the merger with GSK, but the growth headroom offered by this acquisition is huge. Not only that, he also speaks about what Unilever plans with their stake in Hindustan Unilever. Biggest one everyone is eyeing right now is GSK Consumer. First question, when does that happen? How long before we get the NCLT approval?
Yeah, no, I think that is an NCLT, and that will get answered soon.
That happens in FY20 or FY21?
It's in the courts right now, so we'll have to wait for that.
And after the GSK acquisition, you'll probably be one of the biggest food companies in the country, if not the biggest. The margins that you've stated publicly are going to see an improvement of around 1,000 basis points. Do you think there is a chance that you can shake the tree a little more and a few more mangoes will fall?
No, I think in general terms, the interesting question on the GSK acquisition, is firstly why we did it.
We know that why we did it, but I mean, obviously you all weren't present there. There is a lot of scope of growth. HUL's distribution takes GSK faster. There is
no, but that's not the real reason. Then the real fundamental reason is a different reason. The real reason is that the HFD category's penetration is 25%. If you take the weighted average penetration of HUL today, and it goes back to your question on what's the mix of growth of HUL, right? Sometimes I've told you it's been top line, sometimes it's been bottom line. If you take categories and their penetration on one side and the growth on the other, the general rule of thumb, by the way, in consumer goods marketing is that the lower the penetration, the faster the growth, right? Now, in the 90s, when our personal products was the engine of growth, they were all sub 25-30% penetration. Now, all those categories are 80 to 90% penetration. So the primary reason that GSK does is it takes down the weighted penetration, which is what I've written about in the book, which is the biggest driver of growth is bums to seat, new users. And GSK, so it's not about getting extra distribution, it's not about the cost saving, it's not about the mangoes on the tree, all that will happen. It's about the fact that the weighted average penetration of HUL will come down with such a large category. And that's the real reason we've done this.
Right, that is the real reason. It's rather interesting, Nigel. When we were working with our numbers with GSK and all the brokerages were working, they were expecting the synergy benefits to come by EPS benefits of about 10% odd. But the real reason why they went ahead and bought GSK was because penetration levels of the weighted average portfolio of HUL decreases. What does that mean? Soaps, for instance, the penetration in the market is close to around 90%. So in India or the markets that they serve, 90 out of 100 people use soaps already. So there is only so much more that soaps business can grow. But Horlicks, only 25 out of 100 people use Horlicks and Boost, etc. So that brings them a bigger headroom for growth. And as they acquire this business, the weighted average penetration of the entire portfolio goes down. On the one hand, you have something like soaps, which has 80-90% penetration. On the other, you have Horlicks, which has 25% penetration. That gives them further headroom for growth. And like he said, further volume growth means further margin growth. And Horlicks has a business of, as a business, has gross margins of 65%. So 1,000 basis points in terms of margin accretion or synergy benefits with this business definitely can come by. And that is what explains the sort of EPS growth one is expecting.
Interesting, Mangalam. Getting into New Year, that sounds quite interesting. That
talking about Horlicks and Boost.
Horlicks, and I would have thought you were talking about United Breweries or United Spirits, guzzling a few, which you shouldn't. And you should do it responsibly as well. So,
but talking about United Breweries, they also have a non-alcoholic product, Kingfisher Radler. So
you will be going for
I will go for that.
I would like to to know actually statistics. You told us about the penetration in terms of soaps is 80 to 90 out of 100. Horlicks is 25 out of 100. I wonder what number this would be. It'd be quite interesting. Not Radler. The beers.
The beers?
Radler. Okay. All right. Let's move on then. We have Abhishek who's joining in. Remember, the Reserve Bank of India has asked lenders to cap stake in insurance companies, wherein banks have to cap stake at around 30%, NBFCs have to cap it at around 50%. Abhishek joins us to fill us in with more details. Hey, Abhishek.
Well, Nigel, as you mentioned, there are news reports suggesting that RBI may ask lenders to curb their stake in insurance companies. So banks have been asked to cap their, holding at 30%, while for NBFC promoter, it could be at 50%. Now, currently, the bank holding in an insurance company is capped at 50%. This will be done in a phased manner, given the fact that, industry has asked for 5 years in terms of time frame to reduce their stake, while RBI may give in about 3 years time frame. The rule will come into effect from 2021. Remember that banks are a major source of funding as well as distributors of insurance products, and banks actually derive good profits from the insurance companies, both life as well as general. So current holdings of various banks in their life insurance and general insurance business are up on screen for ICICI Bank, SBI, Kotak Mahindra Life, Kotak Mahindra Bank, Canara Bank, IDBI Bank, HDFC Limited, as well as Aditya Birla Capital. Now, CNBC-TV18 has not verified this news report independently. Back to you.
All right, thanks a lot for that, Abhishek. We have, all of those insurance companies lower in trade. With that, we wrap up on